Do you have this question in your mind? What is equity? What is debt? What is a balance fund? Because you hear all these lot of terminologies in various TV ads, but then you get confused. Does it confuse you? So in this video, let us understand the different classification, different types of mutual fund, and let's get the concept clear. Hello friends, this is Tulsi and welcome to my channel The Wealth Sarathy. On this channel, I share the content, the wisdom which will help you to grow your wealth. So now let us understand the different types of mutual fund classification. So I hope you would have watched my previous video. If you not, then I will give the link in the card right now here, which will help you to understand the concept of mutual fund. Now, in terms of the classification of mutual fund, there are primary two classes, equity and debt. Now, what is equity? Equity means business. When you invest directly into the business or when you buy some amount in the business, that is called equity investment. So, for example, when you buy share, it is called equity investment. So, let's put it this way: when you buy share, you are not buying the share, you are buying that value worth of direct business of that particular company for which you have bought the share. Then second classification is debt. So what is debt? Debt, it is when there is a direct money involved, when one party has borrowed money from another party. That is called debt. So debt can be a various form like government bonds, corporate bonds, securities, and out of those are the governments. Because when government need money, because they also need money sometimes to do their carry out their day-to-day work. So when government need money, they borrow money from others and then they use for their purpose. So that money which is borrowed, it can come from some big financial institution or private institutions and etc. So those institutes, when they lend money to government and then the various private organizations, they also need money because it is not necessary that they have that such big amount of capital with them. So when those companies take money from retail investors like us and then lends it to the other organization, it is called debt instrument. So where the money is borrowed by one party from another party for a fixed duration of a time with fixed amount of interest levied onto that. So I hope this help you to understand the concept between the equity and the debt. Now, because equity, you are buying that company, so your return on investment will be based on company's performance. If company does better, you will definitely earn more money. If company does not do better, then your growth will be reduced. However, in the debt, because the money has been borrowed by one party from another party for a fixed duration of time at a fixed interest rate, the money which you have invested in that debt instrument will carry certain amount of fixed return on investment, but it will be low. It will not be as high as the equity because equity is directly related with the performance of the company. So these are two major classifications of the mutual fund, equity and debt. Now below them there are various classifications, and the third one, which is another most popular, is the hybrid or the balance fund, which is in those kind of fund, the fund manager, the AMC, will invest certain amount in equity and certain amount in debt. So thereby the balancing your risk of capital. Now there are more classification under equity as well as under debt as well, which I will cover in next videos. So for this video, this is all. This is Tulsi signing out until I see you in the next video.